Everybody, it is Wednesday, the 28th of November, 2018, and the market reminded us once again why risk management is job number one. We've had a downward bias to this market, and the market can surprise you, and in this case today, it did surprise me that it continued to move higher the way it did. I was thinking that it was likely we'd see some resistance at the volume weighted average price from this prior low and peak here, which came together at that red and green lines, but of course the market closed right at the highs of the day, and then we have to look now at the daily time frame and see that we're also at the year-to-date volume weighted average price. So we've had a tremendous rally off the lows the last couple of days, and this is why we get out of the way when the market goes against our thesis. So we are now with a rising 5-day moving average that's been rising pretty much throughout the day here today, and of course we closed well above today's volume weighted average price. Now in the intermediate term, we just had a big rally, and you certainly can't get excited about chasing stocks up here. If we're going to continue to move higher, I would prefer to see, and the market doesn't care what I want, but I would prefer to see some pullback in here and maybe set up another potential of an inverted head and shoulders pattern. We've gotten ahead of ourselves here on the upside, but it doesn't mean sell short just because we're at this prior level where we've had resistance. But I think instead you're going to see that this market will continue to toy with people in both directions. And the people who chase and try to sell short as it's breaking down or breaking to a new low like we saw in the NASDAQ, breaking a new low is not the time to be a buyer. Just like buying the new highs is not the time to be a buyer. We want to buy ahead of the momentum as the market breaks from low consolidation levels, and we want to sell short as the market breaks down. We don't want to sell short on strength. So for the NASDAQ, we're coming right up to the year-to-date volume weighted average price. It seems like it will continue up towards that level, just as the S&P looks like it'll come up to the conjunction of the 50 and the 200-day moving average. So these markets will remain volatile, and they will reward those who can move with them, and they will punish those who chase in either direction. The Russell 2000 really started out weakly this morning. It was breaking some support in here, it looked like, but then it reversed in here prior to the Fed, and then from that failed move lower came a fast move higher. So framing this back to the daily time frame, we've still obviously got a giant mess here. We can look at it and say we do have a higher low, but we also have lower highs. Maybe this market can continue up towards 156, but the point is you can't just chase with wild abandon. You have to pick your spots, and that's the thing that is always the most important. You can make money chasing a market from time to time, but it's not something that you can consistently do on a daily and weekly basis and expect that you're going to be right and you have the wherewithal to withhold it during the times when the market goes against you. Because as we know, for the longs who bought up at 171, at this breakout, it's been a long, tough journey lower. So we're going to continue to focus on the intermediate term trends. The 5-day moving average is rising, and I would think that we want to look now for the potential that pullbacks find support, and then wait. Don't buy into these perceived levels of support, but instead buy as they rally away from those levels. So a level such as this, we don't want to chase markets. That's the one theme that I continue to stress, and I promise I am not picking on anyone. I was asked in Monday's webinar if I thought it was a good idea to put on a long-term short in the Qs, and I said no. Look where it has come from. Wait for a rally and then wait for that rally to fail. If the rally fails, you would want a short right here for a long-term position, not down here after a market has already made an extended move. Over to the semiconductors, they moved higher here as well. Of course, we've still got the declining 50-day moving average, but we're above a rising 5-day moving average. It's a messy market. It seems likely that this would become a level of resistance. We won't know until it gets there, and then if it gets rejected, then we'll know it was resistance. And again, in this market, maybe this is going to create a shoulder, a head, and a shoulder. So we have to take it in bits and chunks and listen to the message of the market. The biotechs, I had mentioned in the midday video that this was the one market that looked like maybe it would be decent for a purchase candidate if it could get back above the high of the morning. And this one, had you done that, then you would have bought either as it's getting back above this little level here or above the high of the morning. In either case, it would have worked well. If you're involved, I'd say your worst case stop probably goes underneath this little low right here, and perhaps we can finish this move can finish up near the 50, 200 and year-to-date VWAP. If you're long, remember, the primary trend is still lower. The 200-day moving average is down. The 50-day moving average is down. We just got what's called a death cross. Death cross, don't be scared of them. The name sounds worse than what actually happens. Here was our last death cross in the biotechs, and look what happened after that. It's a marketing term. It's not a tradable signal. The financials also moved higher here today. They still have this declining 50-day moving average. Maybe they can rally up to the 200-day moving average in that year-to-date VWAP, but I know that when we have a declining 50-day moving average, it's generally not a good idea to trust that rally. However, it doesn't mean fight it either. We have a rising 5-day moving average. So again, it's always about the interplay of the various time frames and being flexible enough to at least get the hell out of the way if you're about to get run over. If not, then to, of course, get long into a move like this and trade it for your time frame. The energy stocks rallied a little bit here, and as we noted, once again, that these levels, the lower lows, are typically not the place to sell short. This is looking like a failed breakdown here. The next level of potential resistance is up near 67. But the theme of the market today is never be surprised. That's why risk management is job number one. You cannot allow your thoughts of what the market should do to get in the way of what the market's doing and participating, or again, getting the hell out of the way.